Welcome to Goose Live. I am your host, Charlie Stivers, also publisher of Goose Magazine. And in today's episode, we're going to go over the 14 terms you need to know before investing in crypto. And basically, you got to start here at the basics, get familiar with the common terms of cryptocurrency projects and the blockchain technology so you can get started safely, confidently, then profitably, which is what I like to teach. Get started the right way in crypto and keep yourself out of trouble. And stay tuned towards the end where I have some bonus must reads that you can read or listen to and learn like stories of Bitcoin and crypto over the last decade or so, and kind of really learn best by hearing stories about it. So we'll be right back after this brief intro. All right, and we're back. Again, my name is Charlie Stivers, host of Goose Live and publisher of Goose Magazine. And today is actually the first episode that I'm pre-recording because going to a huge crypto convention down in Austin, Texas called Consensus. And that's one of the biggest events in crypto in the US. And then it's right up there with the Bitcoin convention as well. That's in Miami in May. And both of those are very well attended. So I'm looking forward to connecting with other advocates of crypto, vendors, speakers, influencers, all that good stuff. So maybe I'll have some tidbits to take to the next episodes or future guests. So that's what I'm really excited about. All right. So Today's really important, though. Just like anything that we learn, we got to learn the basics. And, as we grow into this, you got to start the right way. That's pretty key. And it keeps us out of trouble. You can do very well in crypto just by avoiding mistakes. So that's why this is so important. And so we're going to start with basically just the terms that you need to know, and we'll go in depth on some of these just so you can apply this as you're on your journey. So let's get into it. And really, the largest barrier to cryptocurrency and crypto adopters is this attitude of, I don't want to learn something new. So what if you had to adopt a new financial system because your nation's currency is unstable, volatile, or losing value in relation to the cost of goods and wages? And unfortunately, that's the reality for millions in South America, Asia, Africa, the Middle East. So, they're in a position where they have to seek an alternative. So after reading, studying, and becoming more financially literate and aware, you may think otherwise about our own crypto or our own currency. And we've covered it in the past, where there's some issues with our currency, and as consumers, we're feeling that the most through inflation, the cost of goods, and our wages not keeping up with those, and that's our reality. So breakthrough technologies always face hurdles of adoption because change is difficult. Often you can use it as an indicator for a great investment opportunity. If something is new and difficult while it's still growing rapidly, this means it's doing things that no other service or technology can do. And this is kind of the trick to making the 10x, 20x, maybe even, I dare say, 100x. So, again, we got to think in the future, 2, 5, 10 years, 20 years down the road, where is this all going to be? Is it going to be just the evolution of the internet or more? Is it going to be the currency of the internet? Those are the things you need to start thinking about. So, getting into these breakthrough technologies before it's easy and adopted by the masses is pretty key to those types of returns, rather than learning something new and being forced into it gives us that edge. Does that make sense? So today's real perspective at this point are people residing in the oppressed countries with unstable currencies that have adopted crypto out of necessity rather than techies like myself or even libertarian thinkers like myself that are using it as more of like an emerging and potentially profitable opportunity. So, that's kind of how we need to start thinking a little outside the box or even outside of our American bubble if you're tuning in from the US. So, roughly, after 10 years, after Bitcoin was founded by Satoshi Nakamoto, we're looking at a $1 trillion plus market capitalization, and it's still emerging, and we're still early. That leaves us early adopters plenty of opportunity, and with that comes plenty of risk. So there's, at this time, 22,000 altcoins. I'll get into altcoins in a minute. At the time when I wrote, basically what I'm reading this outline from, there was only 9,000. So that's about 2 years ago. So, it's double the amount of cryptos. And just like regular fundamental business practices, at least 90% of them are going to fail. So that's part of the challenge, though, is, weeding through and developing this criteria of fundamental analysis and figuring out which ones are going to do well in the long run, which ones, do we want to take a trade in and maybe take our profits right away and don't look back. So we have all those possibilities. So in crypto and blockchain, the concept is particularly enticing because anyone can invest in it. Most breakthrough technologies raise capital privately. We're used to that in the US with strict securities laws, right? But cryptos democratize that process with the coins and tokens that anyone anywhere in the world can buy. And that puts retail investors in the same footing as institutions, venture capitalists, hedge funds. So, we do have a chance. So that's what's so cool. That's what's so enticing and attractive to crypto. So the catch is you have to take the time to do the research or find someone that can help you get there quickly and be a trusted resource. So when the playing field is level, it's the investors with the best information and understanding, not necessarily the most money, who win. So digital currency and blockchain technology are already changing virtually every industry in the world, and that's going to be more so as things evolve. We're seeing blockchain and crypto affect all areas, and it's really kind of fun where, just like a normal portfolio allocation, you'll have, I'm going to drill it down even further than aggressive or conservative, but let's say gold, real estate, emerging markets, technology, green technology. So all those little sectors you can kind of key in on within crypto as well. And one of the other things that I tell people too is maybe take your past experience, your past expertise, and focus on some of those little sectors or niches within crypto first. That way you kind of have some level or base level of understanding, and that may be a good edge for you as well. And then you can deep dive as you kind of come across some other coins and tokens within those sectors. So what we like to do is just arm you with the simple concepts here and these keywords that every beginner needs to know and first understand in order to invest in crypto. Plus, at the end, like I said, we're going to have some of my favorite books that I've read and just kind of really kind of seal it in and ingrain that into your thoughts. Because just like anything in technology, you hear it over and over again. You're like, oh, okay. And then when you can apply it, you're like, yes, I got it. And then if you hear it in a story format, that even kind of ingrains it even more so. So let's jump into the first term, and I'm going to run these down at the banner. So I don't want to show every slide and just speak from the slides. So I'm just going to share the banner of the terms. And the first one is an address. Let's see. I'm going to scroll it. If that worked. Show. All right. Address. So an address, or the public key, that's something that you can share, and it's where Bitcoin or other tokens are sent during a transaction. And it's a string of letters and numbers that you can think of like a username or even an email address. And soon we'll be able to basically treat or use our email addresses as our wallet address. I've already seen that technology. So they're kind of doing cool stuff like that to integrate and make it easier for people to onboard into crypto. So anyone can send you coins and tokens using this public address. And you can also copy and paste it into the blockchain and see what other people are holding. So you're anonymous, but it's not 100% private. Okay. So that's the whole purpose of the blockchain. And I'll talk about that definition here in a minute. So one must know tip about sending to addresses is you can only send and receive like kind coins, meaning Bitcoin to Bitcoin, Ethereum to Ethereum, Dogecoin to Dogecoin. So when you're doing different coins and tokens, those are called swaps. All right, the next term is called altcoin. And let me change my banner. All right, so let's hide that one. Altcoin. And altcoin basically refers to everything that is not Bitcoin. So alt is short for alternative coin. And it's the catch-all term for anything, any crypto or token that is not Bitcoin. And like I said earlier, there's over 22,000 different altcoins that actively trade on the crypto market. I don't know if they're all active. You can actually tell. And CoinMarketCap.com is one of my favorites. CoinGecko.com is another where you can do this type of research and see what the trading volume is on a lot of those. So yeah, it's probably below 10,000 now that are actively traded. But if you look on both of those resources, it's basically like a Yahoo Finance.com, but for crypto only. And you can research almost every coin you want. And it's a big deal when the new coin comes out and it's listed on one of those, because now it's more public. So the next thing we're talking about is blockchain. And let's hide that one and show that one. Okay. So blockchain is basically a publicly recorded distributed ledger, or a public ledger for transactions of Bitcoin or any other crypto asset. It's basically a public ledger of debits and credits for all those transactions and holdings. So it's essentially a log of updated in real time that contains every transaction ever made. And each crypto, actually, let me specify, each coin has its own blockchain. And then each token is typically an app that rides on an application on another blockchain. So that's where you can kind of tell the difference between a coin and a token. And then crypto is more of the catch-all term for everything. You could also say except Bitcoin, because Bitcoiners don't like it to be referred to as crypto. And let's see, these transactions are posted to that log or the chain in groups or blocks. And it's typically very linear. So that's why, there's all these machines everywhere that's recording transactions on the blockchain, and it's recording on every single node, decentralized node around the world. So if someone tries to commit fraud, they would have to change it on every single one. So that's the beauty behind the how blockchain is built and provides that security. So in these decentralized computers, it's just this redundancy of proper blockchain recording. So anyone in the world can view the blockchain at any time, and you can see the addresses only, but no one's personal information. So, that's where people think, oh, this is where I can escape paying taxes. And that's not true, because when you originate your dollars, that's starting in a centralized exchange, or CEX. I'll just use Coinbase as an example because they're a regulated exchange here in the US. And then when you deposit that dollars into Bitcoin, for example, now you have a Bitcoin wallet address on Coinbase. And if you send that to another wallet, it'll get recorded, and then they can trace that back to you. And those exchanges, especially the regulated exchanges, are at one point going to be required to share that information with the IRS and other regulatories or authorities. Let's see here. All right, so the next thing is kind of cool. I'm going to get into smart contracts. And so Bitcoin has always been referred to as digital gold, whereas Ethereum, the second biggest crypto, has been referred to as programmable money. And they do that because of smart contracts. And the way smart contracts work is developers basically write code for a financial transaction called smart contracts, and they put that code on the blockchain, like the Ethereum network. And it's basically a global computer network, which I kind of laid out for you, in which programmers can build the apps of the future. And it's evolved way beyond Ethereum. You'll hear terms like EVM, which is Ethereum Virtual Machine. ERC20 is another term that means Ethereum or Ethereum compatibility. So keep those in mind. And a lot of them are basically Ethereum compatible in some way, or a layer 2 of that is a more improved code, which you'll hear terms like hard fork or soft fork. And it's basically just saying it's a copy of the code with a small little tweak here and there to make it their own. So these smart contracts execute transactions automatically when the certain conditions are met. And they call that basically trustless, which is requiring no human interaction. So that's what's kind of nice about it. It's doing what it's programmed to do without any input from a person who may be biased or who may be greedy, who may be trying to change the code. So it's designed to do that. If there's a code that's changed, that's a soft fork. I'm trying to remember specifically the difference between a hard fork and a soft fork, but basically, I would say a hard fork is more like if someone is doing a straight up copy and duplicating it and then calling it their own with, again, a small little tweak. And then while the Bitcoin blockchain doesn't currently support smart contracts, there are a layer 2 coming out where layer 2 applications that are going to be enabling in this. So this is like really kind of new and becoming more public, and it's going to be really interesting. I've done talks about the Lightning Network with some of my guests, and that's part of what is growing within this layer 2 of Bitcoin. And within that are going to be some of these smart contract technologies. So there's other lookalikes to Ethereum, and they use different coding. Tron is one that was basically a copycat, and the founder of that company is not looked highly upon. And then there's another one, Cardano, which the symbol of that coin is ADA, and I'll talk about this in one of the books that I'm recommending at the end. But Charles Hoskinson, he's actually based here in Colorado, was part of the original Ethereum team. And you'll have to read the book to kind of to hear about the drama behind the beginnings of Ethereum, which is kind of interesting. All right, and next we're going to talk about wallets. And wallets are pretty key part of crypto because that means now you have custody if you have the keys to that wallet. And that means there's a 12-word, sometimes up to 24-word passphrase that you should never, ever, ever share with anyone except maybe a trusted partner or spouse. And that needs to be held in safekeeping because, for example, if you get a new phone and you have that 12-word passphrase, you can now install that wallet on the new device or a new computer. So that's where this comes into play. And you can restore wallet without like having to download everything. You just got to type in the 12-word passphrase. So the way wallet works is you have public and private keys, and the private keys are the ones I just mentioned, and that's where your crypto and Bitcoin, altcoins are all stored. And you can think of it as like a digital vault or a bank account on a device. It can be an app, even it can be on your browser. I have another computer that I don't do any web surfing on, that is an extension in the browser. And instead of a login and password, you just hit connect wallet and boom, now you have access. It can also be a hardware device. I do have a separate phone that I use, and I don't do any surfing or social media on that one. It's primarily just for crypto. And there's also like thumb drives that are also either cord connected or Bluetooth connected. So it's not always connected to a device. And those are the ones that you hear some of the horror stories about, where I lost my wallet. So that can happen. So those are some things that you have to treat like cash or like gold and protect it. Put it in a fireproof safe, or a locked file cabinet, or even a safety deposit box. If you have enormous amount of Bitcoin on there, you probably want to put it in a safety deposit box, or a very secure gun safe. So wallets are very important. And the other main thing you got to know is you don't want to keep your crypto on a centralized exchange like Coinbase, because what if the regulators said, Coinbase, we're shutting you down because we don't want anyone else, putting in or taking out money. Now at least you have it on a wallet, and your assets are not at risk on a centralized exchange, even like FTX. That's a perfect example, real life example. But in this case, it wasn't necessarily shut down. They went out of business because they were stealing money and basically, committed fraud and theft, and the worst case scenario. And people's coins and tokens are just stolen. And then ultimately it was shut down. And I think now it's still operating, by more trusted people, I guess. But, I think it's more to recover assets than anything at this point. So, we'll see what remains of them. And I think they have more operations overseas than they do here in the US. All right. So next we're going to go into what decentralized means. And that's also pretty key. Because, the whole reason why Bitcoin was started was because centralized banks and governments were basically the reason for why we had the 2006, 7, and 8 banking and credit crisis. And the catalyst of that was the banking sector using mortgage-backed securities and leveraging that and leveraging it, and it finally caught up to them when the prices of real estate just started crashing. There was no way they could survive, and some got bailed out and some did not. So Satoshi Nakamoto wanted a decentralized, cashless, peer-to-peer system, and came out with Bitcoin. And the key there is decentralized computing is making this available to all of us as users, and now we can do business peer-to-peer without any oversight. So decentralization refers to having decisions, planning, and resources distributed or even delegated away from a central or authoritative location or group. So true decentralization means anyone can participate. So that's also that democratization of our money, and no censorship of money either. So most cryptos are decentralized forms of currency. So, and to further piggyback on that, we have decentralized applications, or called dApps. So DAPP. I'm going to put that one up here. All right. And these are pretty cool because they basically look like a website, but at the top you'll say launch application or connect wallet are one of the ways that you can gain access to whatever the application is designed to do. So a decentralized application is a computer program that can be accessed by anyone and typically has crypto built into it. So like mobile apps on your Apple or Android device, these dApps can do virtually anything. For example, they can be used to trade cryptos, publish content to the internet, play games. Decentralized finance is a huge sector in this, where they're basically creating models of centralized institutions like annuities, certificates of deposits. And do you think there's a lot of profit left over if you're eliminating the middleman, the banks and insurance companies? Heck yes. So it's really cool to see how they're basically replicating these models, but in a decentralized way, using all these cool applications and programming, and um, and not taking custody of your money. So I'll go into how some of that works here in a minute with staking and things like that, where you can earn yield, which is like how you earn yield from a bank and insurance company. The main key here is it's not guaranteed. So, anytime you see a guarantee on some of these, that's when you have to be pretty leery, because, you know, they don't have actuaries like an insurance company or a bank has, where they know they can guarantee 6%. And when you cut out the middleman, some start, well, I think I can pay out, um, 50% per year. And so if they have some kind of revenue that's dumping into the treasury or the liquidity of it, that may be possible. But if they're relying on new user capital, that's when it becomes more of a Ponzi. So, and you'll hear the term Ponzi-nomics once in a while when you're talking about DeFi or decentralized finance. So the real key is to look at the utility of this program and where are they bringing in revenue from to afford that ROI that they're paying out to their stakers or holders. So unlike apps in Google Play or the App Store, dApps are resistant to censorship and are difficult, if not impossible, to shut down, because once they're launched or published to a blockchain, they'll be as available as long as that blockchain exists. So that's another thing that we kind of have to watch out for is, there's blockchains also called layer ones, and who knows how many of them there are, but you can look through the top 50 or even the top 20 in like CoinMarketCap, and a lot of those are layer one blockchains. And there may most likely will be more in the future, just because we all like to innovate. But how many different Microsofts, Googles, Apples are there that really make it? And that's kind of how we need to think about crypto. And yes, this is global, so that helps. And some of these are kind of regional, like that one Tron has more of an Asian influence. It was launched over in Asia, so most of their users are over there. So it'll be interesting to see how regionally different blockchains kind of adopt based on where they're located or where they're launched. And some choose to stay away from the U.S. because of our restricted policies and regulations. The uncertainty behind all this makes it really hard to plan and operate without fear of being shut down or a target by regulators just because the U.S. says so. So that's one thing that we have to manage too. The other thing that I mentioned earlier is a decentralized exchange or a centralized exchange. So in this case, we're going to talk about a decentralized exchange. And piggybacking on what we were saying earlier is they can't be shut down because they're governed or controlled by smart contracts, and they operate according to these programs, which is kind of cool. And again, you just connect your wallet to these, and now you can swap or buy. And let me dig into that one. So the decentralized exchange is a marketplace where you can buy and sell cryptocurrencies or tokens that are not controlled by a single organization or behold to a central authority. Buyers and sellers deal with each other on a peer-to-peer basis or by connecting to liquidity pools using dApps and smart contracts. Because DEXs are not controlled by any one person or published to one or more blockchains, or they are published to one or more blockchains, they're virtually impossible to be shut down. So let's take a break here for a minute, and I need a drink of water, and I will be right back. And we're back. All right, let's see if this thing is catching up. Got a little choppy there for a minute on my end, so I will keep moving along like everything is normal. So, anyway, so the next thing that we're going to talk about um, is double spending. And double spending is pretty fascinating because that was one of the key things to prevent fraud or being able to spend coins and tokens more than once. So Satoshi Nakamoto thought about, planned this in and basically came up with a time and date stamp. So it's more like a time chain almost, if you think about it. So that was one of the security mechanisms or anti-fraud mechanisms that he developed. So that's pretty key in this case. So let me get this. Okay. Sorry, my computer is pretty choppy at the moment, so it's making it hard to navigate on my end. Okay, so hopefully it's catching up on your end too. And we're back. All right, so double spending was a big issue when digital currencies were first conceived. And then, like I said, Satoshi Nakamoto figured this out. And it was basically possible to make a copy of a crypto or token and spend that copy on goods and services, thereby never really actually paying for it. And Bitcoin solved this problem with the invention of the blockchain or this time chain, making it impossible to double spend the currency. And now it's one of the most fraud proof currencies in the world. And the next big term that we've all heard about is mining or miner. And let's go into that a little bit because it's part of this whole decentralized network infrastructure that is so cool. So a miner is a group of computers that supports a blockchain network. And the miners are run by individuals or groups of people who contribute money towards buying powerful computer systems. And the miners compete to solve mathematical problems or transactions on the blockchain. The first miner to solve that problem gets to publish that block or a group of financial transactions to the blockchain and then gets paid a reward in crypto for its efforts. So they are doing work to get the reward. And that's kind of where this proof of work comes from. And the Bitcoin miners, for example, are paid in Bitcoin, and Ethereum miners were paid in Ethereum when Ethereum was proof of work, and now they just transitioned to proof of stake. So next, we talked earlier about a public key. Now we're talking about a private key, and basically, let's see here. It's this long alphanumeric sequence of words and of letters and numbers. And let's see here. Sorry, just trying to put these up so, we're all visual learners sometimes too. So a private key is an alphanumeric sequence that gives you complete control over the crypto in your wallet. A private key should be protected with the same rigor as cash or gold because you can lose it. And if you lose access to your Bitcoin and that account, you lose it forever. Okay, there's no centralized entity that exists that can help you recover your private key for you. It's not like Facebook or Google. If you forget a password, you can say, "Can you reset my password?" It doesn't work like that. So that's where this whole personal responsibility comes into play. And we have the control, but we are ultimately responsible. This is a solo sport of sorts where you're the boss. So more important, if someone gets your keys or those private keys, they can take all of your coins and tokens from you. Like I said earlier, if you have that, you can install it on another device. That means someone else who has that can do it as well. So like even be careful on camera. Like once in a while, you'll see like a camera shot, or I think I saw even like a police bust or an arrest where the cops were pulling stuff out of his wallet, and they're like, "Oh, what's this?" And it was like this. And he showed it to the camera on his chest, and it was the dude's wallet passphrase. And then it went out on the internet. So whoever jumped on that first basically took over this guy's crypto wallet. So some wallets give you a seed phrase instead of private keys. It's kind of the same thing. And the seed phrase is more what I was talking about earlier. That's the more commonplace one of these 12 to 24 words. And those are actual words and not an alphanumeric sequence or phrase. All right, so I mentioned this earlier too, called proof of stake. And this is kind of where this is all headed because it's all cloud-based, and there's plenty of cloud data centers all around the world that you can operate from. And it's a consensus mechanism, basically, that it's a set of rules that protect the blockchain from manipulation, in which stakers publish financial transactions on the blockchain. In exchange for this right, they have to stake or pledge or even lock up their crypto as a commitment that they won't cheat the system. And if they do try to cheat it or publish false transactions, they can lose their tokens. So if they operate honestly, they can earn more tokens. And then on the other hand, we have proof of work, which is the other consensus mechanism in which blockchain is secured by powerful computers or miners performing difficult transactions and calculations. Miners get rewarded for solving a block and adding it to the blockchain, requiring that miners solve a difficult, time-consuming calculation slows down the process. So this helps limit the rate at which new blocks can be generated by the network, and ensures that the reward is spread across many miners. So thereby preventing the network from becoming centralized or being dominated by a single miner. So I just realized that it's not a timer on here, and I'm not keeping track of my time either. So hope we're going to, oh, here we go, 43 minutes. Okay, we got 13 more minutes to go. All right, so thanks for hanging in there. Sorry that this one's kind of flying by the seat of my pants. It's a little different interface since I'm doing this pre-recorded. So next is staking. This is kind of one of my favorite things that I like to do. If you can do staking safely, you can generate yield that is beating what you get in even mutual funds. That average anywhere annually from 8 to 12%. And let's say you double that and get 24% per year. Now, if rule of 72, you divide 24 into 72, that's 3. And now your principal is going to double every 3 years rather than every 6 years. So you're doubling the amount of doubling periods, which is pretty cool. And that's a more conservative type of rate of return, this 20 to 24%. If you get higher than that, the whole risk versus reward comes into play. And that's where that other criteria you need to make sure of, if they are generating revenue in some other ways, that can be real. So that's what we need to look out for the future, and go after these better returns. That looks like their business model is pretty solid. So let's see here, staking. And so staking entails locking up or pledging your crypto to help a proof of stake blockchain function properly. By locking up your crypto, you get the right to post new blocks to the blockchain in exchange for compensation. So you're also providing liquidity to it in a way as well. So you can also delegate your stake to another party who posts transactions to the blockchain or has a vote so this kind of comes into play with the governance of it all too, which is kind of a cool part in this whole democratization of this, where as users or stakers, we do have a say in how um, they're governing maybe the treasury, how often they're paying out, um, you know, if there's extra rewards left, how are they going to distribute that evenly? So there's a lot of things where this is really kind of evolving into this new type of governance or management structure that is um, ruled by all of us in this democratic type of situation. So some of them do have a weighting to, let's say, there's a couple of whales that control 40% of the stake or the treasury, um, or the whole blockchain. That's something that you have to watch out for. So some of them I've noticed will even limit, let's say they are, but they're only giving the voting rights up to like 5%. So it's kind of cool to see how they are figuring this out to make all this a little bit more fair for all of the participants and users. So if you or your delegate submit false information, you could lose your stake. So again, they're rewarding good behavior and punishing bad behavior in this. All right, so I think that was 14 terms that you need to know to um, before you get started. So, to sum this up, everyone wants to produce these huge returns. They call them alpha returns in crypto, and that beat the broader market. And investment funds literally spend billions of dollars a year researching, moving in and out of stocks to beat their peers. And every time you buy a stock, you're competing against each other. Whereas, with crypto, it's kind of flipped that. Yes, it's all supply and demand. And, sometimes people who got in early are selling when people who got in late are buying. So yes, there is, that element of risk. So, again, we're still early, but there's still people that got in before you did too. So that's part of the risk as well. Especially if some of these are like some of these meme coins or type of pump and dump. That's where it can get even more risky. So the crypto markets are so new and moving so rapidly that even beginners can uncover some of these overlooked opportunities. And with a little research, some hands-on experience, then you can determine that risk versus reward threshold. And it's possible to find a possible 10, 20, 100x hidden gem that pumps, but just know that you can lose it just as quickly. So, use some of these terms as a stepping stone and, just kind of learn everything you can about crypto. And, then, walk through the process of buying Bitcoin, buying Ethereum, putting it on your wallet, or, buying it on exchange and then putting it in your wallet, or paying in Bitcoin. In the magazine, we wrote about how we taught these 7th and 8th graders how to use a Bitcoin wallet at their entrepreneur fair. And, we put $5 on each of the kids so they could go shopping at their friends' businesses. So that's where you have these real life applications, and you can see how simple it is once you learn it, once you do it a few times. So we encourage you to begin your journey to get today before the masses do. And, in doing what most folks refuse to do, and learn something new, have fun. This could be life-changing results for all of us. So that's, how we really want to encourage you guys to look at this. This is a pretty big opportunity, and we just have to navigate through the risks. So I'm going to share some of my, see if I can share my screen real quick. So one of the first books I read was during COVID. And let's see, I'm just going to share my screen, make it simple. Went on a road trip with my kids, and we went down to ultimate destination was Las Vegas. We're based here in Colorado. And so, the kids were doing their thing. And I put on an audiobook. I came across this one. It just came out called The Infinite Machine by Camilla Russo. And this was basically, the subtitle is How an Army of Crypto Hackers is Building the Next Internet with Ethereum by Camilla Russo. She grew up in, I can't remember, I think it was Venezuela. And, they dealt with unstable currency, inflation, blah, blah, blah. And so people started, when they get paid, they were buying Bitcoin and doing business on the street, with their Bitcoin wallets. And then the next one, let me go a little bit further into this. I have some time. So basically she talks about the beginning and somehow she got involved with them, which is really cool, and how the different players within Ethereum kind of came in and out of play. And they talk about Vitalik Buterin, who basically was very interested in Bitcoin. He was actually the writer, the founder of Bitcoin Magazine. And then he's like, well, Bitcoin's so limited. Let's figure out how we can make it be programmable. So he came out with Ethereum. And so they tie in some of the drama into all that, which is kind of fun, and it makes it a good story. The next one is the Bitcoin Standard. And this one's pretty cool because it goes through, history, ancient history almost, of how people used to buy and sell, barter, trade for goods, and using different forms of currency back in the day. And so you get a little bit of a history lesson with it. And then it dives into, our current centralized banking problems, and then the alternatives that are coming around, primarily Bitcoin. And then lastly, you may recognize this author, Ben Mezrich. He's wrote a lot of fun books. He was actually wrote a couple of episodes on Billions, I think the show was. And this one is about the Winklevoss brothers, who you may remember from the Social Network, the movie, and how they were cheated out by the guy who started Facebook. I just spaced his name, Mark Zuckerberg. And but now, so this is more of a story of redemption. They found out about Bitcoin and loaded up, and it goes through like all the stuff that they went through to protect it and things like that. So that one's a pretty cool story too. Thank you for tuning in today. And this has kind of been a fun one, but we need to start with the basics. Like I always say, get started safely so you can be confident and then profitable. So that's the best way to get started and have fun with this as much as you can, and just keep learning. I'm learning too. And, once you get the basics down, it's so helpful. So one of the things I do is I started out with this, just sharing my results on social media. I started a group called Cryptocurrency for the People, just a meetup group. Started picking up clients, was hoping to make it more like a community, and I think it'll come back. We're also kind of building that within the Goose Magazine community too, which I'll get into in another episode as this evolves. But most people hire me privately now, which is fun, where we can really get people up to speed quickly, condense timeframes, speed up your learning curve, get you set up with these wallets and doing transactions, give you ideas on, talk about passive income, yield generating income, some of these potential 10, 20, 100Xers that are super risky or just a lower market cap, but may have the potential because of that niche that they're in that I was talking about earlier. So it's just fun to see how you can allocate a portfolio to kind of cover all these bases in different sectors and niches. If you don't mind, I'm going to close with this, and we will catch you next time.